All right, good morning and welcome to the 11th annual Loan Review Industry Benchmark Survey, courtesy of DiCOM Software. As we get going, I wanted to give everyone a special thank you. If you're on this call, that means you completed the survey or are a DiCOM client, and most DiCOM clients completed the survey as well. So thank you very much for your participation. It's without your participation, we don't have a whole lot to talk about today. So I'm Jim Alexander. I'm the Senior Vice President of Sales and Marketing for DiCOM Software. I'm joined, as always now, by Kent Kirby, goes by Kirby. He's the Senior Vice President and Director of Client Experience, formerly Director of Complex Risk at Commerce Bank Shares. So he's got a lot of great color commentary. He's going to be helping me out as a co-host today. So very excited to have everyone joining us and very excited to be doing this for the 6th time. So I've been with DiCOM enough to have a few of these under my belt, and I really do enjoy sharing back this information to everybody. So a little bit about the webinar. Why are we here? So we're here because we care about the loan review industry. That's DiCOM as well as everybody here on this call. And what this information is really designed to do is to help provide you benchmark information so you can compare your bank staff sizes, your processes, and your practices against others in the industry to see, hey, are we in line with the industry? Are we out of line with the industry? And if we're out of line with the industry, is there a reason for that? Or do we need to dig in and potentially look at our processes? So it's a great opportunity for us to all take a step back and kind of look at what's happening in the landscape of the loan review industry and see what emerging trends there are. So very excited about offering this information. And, you know, we're going to go through a lot of the information at a pretty high level. We'll take some deep dives here and there, but really the idea is also that it'll provoke thought on your end. So if there's anything that you see in these survey results or anything that you want to communicate back to us, by all means, reach out to both myself, got my email down here, as well as Kent or Kirby. We would love to see your insights, your feedback as well. We'll be here for about 45 minutes. And I did want to point out that all attendees are muted, and that's really just to eliminate background noise. We have quite a bit of ground to cover, but if you do have questions, like I said, send them directly via email or use the chat panel in this webinar interface. So if you do put a chat in, we're probably not going to be able to address it today during this session, but we will go through the entirety of the chat panel, and if there's anything that requires follow-up, we'll do so in very short order. So just a little bit about what we'll be talking about today. We've really broken the survey down into about 5 or 6 components. The first being survey demographics and portfolio composition, really the who responded and what these respondents' portfolios look like. Department staffing, which is always a very popular area of the survey. We'll be talking about kind of some trends there and what impact that has on the industry. And then we'll dig into the loan review process, the credit risk management process, and then reporting and guidelines. It got some interesting insights and findings in each one of these sections. I will point out that each year we do our best to improve the survey based on your feedback and based upon what we're seeing in the industry. So if we're seeing something occurring, we're going to add a question or modify a question so we get better results that are more meaningful to you. So we did that this year as well in some of these key areas, staffing, process, and reporting and guidelines. So let's get into the nitty-gritty. First off, participation. Thank you. Again, we had a good turnout from the industry, and we had approximately 100 results or 100 survey respondents this year, and they're broken down across the different asset sizes in the industry. And you can see pretty strong participation percentages across the asset ranges. I will point out that the $50 to $100 billion asset range shrank a little bit this year, as did our respondents. So we got a pretty good participation percentage, but it's a pretty small segment. So we may look for the 2023 survey to rejigger some of these segments to make them a little more robust and to get appropriate responses across the board. But we'll be reporting back results in all asset ranges, excluding the under 1 billion. We just didn't have enough responses to segment that information out. Those responses are included in the aggregated results, but we're not going to be reporting on that particular segment. So we look at loan portfolio sizes. Nothing magical about this, generally in line with what we've seen over the last several years. When we're looking at the $1 to $5 billion asset range, CRE is making up the largest percentage of your portfolios. As we look across kind of the mid-size bank ranges, we're looking at a generally balanced C&I versus CRE in that segment range. And then once we get up to the mega bank segments, really above 50 billion, we're finding that, not surprisingly, C&I makes up the largest percentage for those banks and gives you some kind of benchmarking information to see kind of where you fall within your peer group. Moving on to some of the exciting stuff. So this is a newer question for this year. We asked, I believe, 2 years now, and it's really looking at whether or not banks are fully staffed or they're leveraging external resources, third parties, to complete their reviews or to augment their review staff. So this used to be a binary: do we insource, do we outsource? Over the years, we've kind of rejiggered this question to really dig in and find out, one, if a bank is fully staffed without leveraging any external resources, or if you're leveraging external resources for added capacity or on a continual basis. So a lot of different options here, and it gives you a real good feel for the industry and allows you to kind of benchmark your practices and your staffing perspectives against others in the industry. And we're finding that the majority of banks are still leveraging internal employees, but partial outsourcing is becoming more common, and we'll dig into that a little bit more. And we also said, hey, we're looking at this year's results. Let's compare them to last year to see if there's a trend. Guess what? They're virtually identical to last year's results, which are great because it tells us sometimes when you know that things are staying the same, it's just as important as knowing if they're shifting one way or another. And what we're finding is that, again, the majority are fully staffed with internal employees. And then there's a fairly decent percentage of respondents that indicate you're leveraging internal staff on an occasional basis for added capacity, as well as on a continual basis. And we've got a couple of root causes for why that may be occurring. But again, the results are consistent from last year. Very, very consistent, actually, almost eerily consistent. So why do banks leverage external staff? And we're finding that increased workload and lack of skilled staff are those primary reasons. And that's consistent with last year's results as well. While 63% of respondents are not outsourcing, a fairly high percentage, 23 and 18%, are outsourcing to some degree or another. And the primary reason is really support for increased workload. Again, consistent with last year's results, and we are seeing that is a consistent theme throughout a lot of the questions and responses that we get through the survey, and we'll continue to dig into that through this webinar. So staff composition by bank size. This is another great slide for benchmarking to identify, hey, are we understaffed? Are we right-staffed? Are we overstaffed in comparison to others within our asset range? And across the board, we've got, managers with management responsibility only here in blue. And then we have in orange, managers performing hands-on work. We have senior staff in gray, and then junior staff here in orange. And the difference between senior staff and junior staff, as it's described in the survey, is that senior staff are seasoned professionals that can complete an entire review without any support. Junior staff tend to need a little bit of support and guidance through the review process. So that's the delineation there. Couple key takeaways that we've got on this slide, and there are a lot of things going on here. First, managers are more likely to perform hands-on work at almost all bank sizes. So that is something we've seen that's been fairly consistent, but probably a pseudo trend going forward. And we're even finding that banks over 1 billion are more likely to leverage their managers to actually be performing hands-on review work. And that is up from last year in that particular segment. We're also finding time and time again, the senior staff make up the largest percentage of banks, and that's over 5 billion this year. But you can tell that not a big delineation there here at the smaller banks just because the staff size is not extremely large. And then we're finding that staff sizes from 10 billion to 100 billion are trending down from prior year's results. So you see these downward trends here in these kind of mid to upper segments here. The only segment that we're seeing an increase in headcount is actually in that over $1 billion range. So increased workload, increased additional responsibilities, and declining staff, you're going to have to be finding some efficiencies, and we've got some data that would suggest that you're probably doing so through technology, automation, and otherwise. But a lot going on in this slide. It's always one that people like to dig into. So if you have any questions about these results, do please reach out to myself and Kirby. We're also finding that loan review staff experience has normalized across bank sizes. And this is an interesting trend. It's been a 2-year trend where it used to be you'd see a increase slope here as we got across bank sizes, that the larger banks tended to have a more seasoned, experienced staff level. And we're not seeing that so much anymore, as you can see from the data here. And we're finding that anecdotally, we're seeing a lot of folks moving from bank to bank, and a lot of folks moving from large banks to smaller banks, and kind of that virtual workforce is helping to make staff more mobile and able to shift. So we are definitely seeing that echoed here in the results. So interesting 2-year trend as well. And then we dig into whether or not loan review staffs are able to have dedicated admin to support their process. And what we find, not a huge surprise here. Most of these smaller bank segments indicated here in red do not have any support. We are finding that there is a tendency to be able to leverage support staff from outside their department across some of the smaller bank sizes. So that is, somewhere around 10 to 15, 17%. So that's notable, but unlikely if you're in those segments. Once we get kind of above 20 billion, we're seeing that, either 1 or 2 dedicated admin staff for the department. And not a huge surprise, some of these departments are quite large. So this slide, again, pretty good for benchmarking to see kind of where you fit amongst your peers. Salary levels. This was a notable shift from last year. We have seen salary levels rising year over year, and this year was no exception. It was actually quite notable. When we look at the salary ranges here across the different asset sizes, we break that down by junior staff, senior staff, and management staff, and then we provide a trend line to kind of identify what the ranges and the trend is across the various bank sizes. So again, we're seeing staff salaries higher, and that's echoed here. If we look at the 2021 salary ranges, junior staff was 55 to 104, senior staff 81 to 129, management staff 120 to 151. Fairly significant increases here. And what we did is we took the ranges for all 3 categories, and then we took the upper end and looked at a percentage increase. So the junior staff have seen about a 4% increase, pretty standard across last year. However, senior staff were showing a 7% increase, management staff a 21% increase. So fairly significant there. And I know, Kirby, you might have some thoughts on this slide. Is there any additional commentary that you wanted to provide here?
This is more food for thought than anything else in terms of the actual survey, and that is that there is a downside to this slide. On the one hand, the salaries are going up. On the other hand, they're going up because you don't have any junior staff, and so you're having to pay more to retain your older staff because they can go somewhere else because remote's remote, right? And so there is this downside of no junior staff, and I think this may need to involve some rethinking of balancing the loan review workload between meeting the objectives in the 2020 credit review guidance, as well as being interesting to young people. And so you have to kind of ask the question, if you look at the same loans year after year and expecting a different result, is that something that's going to be attractive to young people? So I think there's some opportunity here to revisit your workflow and as I said, balance between the objectives and making it attractive for younger people.
Thank you, Kirby. Okay, and then we took a little different spin on the regionalization of salaries this year. Last year we did it by uh, federal district, and what we did this year is just looked at data points for states that had multiple responses, 3 or more data points, and then we plotted them out. So this will hopefully give you a little more granular benchmarking information if you can find your state or a state that is fairly representative of your state. And we find that the regionalization of salary does have obviously a fairly large impact, with California being kind of on the higher end, which is not a shock, followed by Massachusetts. And then we have PA and Washington down here on kind of the lower edge, where we've sorted this by management salary, but you can see that Washington has a little bit higher senior staff and junior staff salaries compared to PA. But again, this will provide you some fodder, some benchmarking to kind of compare your salaries against others in the industry in the same region or state. In bonus eligibility, this is consistent fairly year over year. We're finding a slight increase in propensity to provide bonuses to loan review staff, but it's been fairly incremental year over year. This year, we've got 89% of respondents that are eligible for a bonus. And the two kind of bonus options are the bank-wide bonus pool and then individual objective-based bonuses. And we're finding that the bank-wide bonus pool is by far the most common this year, as it was in the last 6 years I've done this. So nothing shocking there. Then we looked at average C&I and CRE exposure per junior and senior staff reviewer, and we did a 3-year trend just to see, you know, is there a shift over the last 3 years, and also to help you kind of normalize. You know, each year we have different respondents, and you know, a lot of the same folks respond each year, but you get a little different view, and it can help you normalize the information. And what we're really finding is that over the last 3 years, there's not a distinct trend up or down across the various bank sizes, and you know, fairly consistent year over year. So we kind of took a step back and we said that feels counter to what we've seen over time. So let's take a further step back there. And what we did is in 2014 was when we really started capturing this data in a meaningful way. So let's go all the way back to 2014 and compare that. And we have found that if we're doing an 8-year comparison, 2014 to 2022, there is a fairly significant increase in exposure per staff reviewer. We see, you know, things like 1 to 5 billion is up 31%. We've got the 50 to 100 billion up 64%. So fairly significant increase over time, while the last 3 years have been fairly stable. So we want to kind of provide two views there, because we do really believe anecdotally, and now based on the data, that you are having to do more work today than you did several years back, and that's echoed here when we take a further step back in time. We also look at you know, training perspectives across the different asset sizes, and we do find that staff training likelihood increases with the size of the bank. However, most banks are likely to perform some form of training, with the 1 to 5 billion obviously being the least, with 50% no. But once we get up into the larger asset ranges, we find that, you know, you're going to be an outlier if you don't require staff training, and that's essentially what you can do for benchmarking purposes, whichever asset range you fall in. Then we also look at the approach to loan review training, and we do find that the vast majority of respondents are leveraging both internal and external resources to conduct their training. So holistically, if you're doing kind of a hybrid approach, you're in the norm. Okay, and then we look at workforce location. So we know that the pandemic has kind of accelerated trends for a remote workforce, and that is definitely echoed in our survey responses, where we're finding that fully remote, about 1 in 3. 1 in 3 shops are going fully remote. And then the most common response across the overall responses is 46%, so about 1 in 2 are doing a kind of partially remote hybrid combination. And then, you know, 1 in 4 or so, or even less than that, are really doing some sort of business office work perspective. So if you're doing a hybrid or a fully remote workforce, then you're in the norm here. We also break this out across asset ranges, so we can look at the perspectives with each sized bank, and we get a similar perspective with partially remote being kind of the most common across the various asset ranges here identified in orange. And then another important thing is this temporary or permanent. And again, echoing back to last year's survey results, we're finding that the work location tends to be permanent in most cases here, with the lowest percentage being 57% in the 20 to $50 billion asset range. But across the board, we're looking at some pretty high percentages and confidence level that what you're doing today is probably what you're going to be doing for the foreseeable future. So then we look at productivity metrics. And this is interesting because we do track this year over year, and we're finding that 79% of banks are tracking productivity metrics. That is up 8% from prior year, so that's fairly significant. And it was up in 2021 compared to 2020. So this is definitely a trend that we're seeing to track productivity metrics. 6% of banks did indicate that they have plans to start tracking productivity metrics. So about 85% either are tracking or plan to, and then 15% aren't tracking any metrics and have no plans to do so. And that's down 4% from prior year. Digging in to a little more detail across the various asset sizes, we do find that there's different perspectives to the metrics that you're tracking. Fairly common response is that number of credits reviewed per week for each month, for each reviewer is a pretty common response. And then also we find that a common response is tracking at the department level. So not individual metrics, but what's our overall productivity as a department, what's our output. So a lot of different perspectives there, and you can tell that each bank and the industry in general has different perspectives on how to track productivity. So that's something we're actually tackling on the DiCOM side with some enhancements to our software as well to make that process more seamless and easy to do at both the individual level and at the department level. And then we look at loan review productivity. This is really files per week for each staff reviewer. And we're finding that we have a 2021 graph here, as well as a 2022, and then a 2-year average just to kind of normalize the information across multiple years. Then we have a trend line that is on that 2-year average. And we do see that there is a decreasing slope, so a decline in productivity based upon the asset size of the bank. And that's largely, we believe at least, due to the complexity of the deals at the larger banks. They tend to be a lot more complex, a lot more effort has to go into the reviewer. So we're not surprised to see a slight decline there as the asset size of the bank increases. And as a general benchmark, we're looking at between 4 and 5 files per week per staff reviewer. So that's another good benchmarking slide to kind of see where you fit on that continuum as well. Some highlights. So banks of all sizes are more likely to employ a larger percentage of senior staff compared to junior staff. Experience levels of senior and management staff seem to have normalized across most bank sizes, and that is a 2-year trend, as we discussed. Banks of all sizes are leveraging a remote workforce, and the survey does indicate that that is likely to be a permanent perspective. Salaries are increasing, and it was the most notable increase was in the management staff level, followed by senior staff. Asset exposure per reviewer has remained steady over the past 3 years, but if we go all the way back to 2014, we have seen a notable increase. So you are doing a lot more than you were doing likely in 2014 because penetration percentages were fairly consistent. So you're still hitting those same targets with really less resources compared to the size of your portfolio. And the average number of files per reviewer per week is about 4 to 5. Moving on to the loan review process. Kirby, I'll turn it over to you for a minute.
All right, thank you. So this is the primary objectives of loan review. And when you look at the results, this is very consistent with the 2020 credit review systems guidance issued by the regulatory agencies, with risk rating accuracy being the most important, asset quality, and timeliness, underwriting, and policy compliance. So those are pretty much right down the list of the 7 objectives of credit review. So that's good. Next slide, please. The problem is that we don't necessarily see the execution being consistent with the objectives. And so if you're really looking at a risk-based approach, you're really looking at things like growth, economic impact, the types of loans, weighted average risk rating, et cetera. And what you're really seeing is that there's a lot of emphasis on for example, last year's results. And so it's not totally inconsistent, but there are some inconsistencies between the objectives and actually how you're carrying out your risk assessment criteria. It's just something to think about. Next slide, please. The next is the importance of how we determine our scopes, risk rating, of course, being the most important. Again, very consistent with the 2020 guidance. So we're saying what the regulators want to hear. Next slide, please. But again, it appears that we tend to be somewhat inconsistent in our execution. So, we're looking at things like the large borrower, the problem loans, and those are 2 categories that tend to get picked over pretty good in your banks, either through the underwriting process, the annual review process. In a lot of banks, loan review is part of the watch list process. And so you just have to ask the question, are you really kind of double counting your work here? And maybe it'd be more productive if you look a little further down the list and some of the priorities, such as new borrowers, specific industries, past due status, et cetera. So again, it's not totally inconsistent, but it just raises the question of, are we actually executing like we say we are going to do? Next slide, please. Continuous monitoring. So this has been kind of an interesting thing. And when I first started loan review 35 years ago, it was all examination. And obviously now there's a more balanced approach between continuous monitoring and exam-based. And this is fairly consistent with what we've seen in previous years, that most banks have a balanced approach. What I did find interesting is that last year we had approximately 8% of the respondents said they were only doing continuous monitoring. That's dropped in half and was basically picked up in the balanced approach. So it still seems to be the best practices approach is to have a balance between the examination process and the continuous monitoring process, which brings us to the next slide, which is how are we doing these reviews, continuous monitoring reviews. And what's interesting is, again, when continuous monitoring first started several years ago, decades now, it was really kind of a continuous monitoring of individual credit, the most classic example being the watch list. And that's morphed over the years. And so now what you're seeing is continuous monitoring is the continuous monitoring of portfolio segments. And so you have, and that's exactly what you're seeing here now. It's sort of the new loans, the high growth loans, specialized portfolios. So that the results tend to show that shift has occurred, and that people are now doing continuous monitoring on a portfolio segment as opposed to individual credit. Next slide, please. And then this slide talks about target percentages, thresholds, if you will, and they're hovering pretty much around 40%. That's kind of where everybody is. 15 years ago it was 60%, now it's at 40%, and that's kind of where everybody's shooting for. The issue really boils down to, is the threshold an outcome or a goal? And if it's a goal, which I think it is, because if you remember that previous slide where we talked about large loans being a primary determinant of what you're doing in your scoping process, you're reaching for your goal. And that really raises the question, if you're looking at credit like Microsoft and Amazon, yeah, they're going to have some issues in a downturn, but they're not going away. I mean, they're going to be around for quite a while. And so why are you spending a lot of time looking at those types of deals when you should be looking at where more risk-based problems are? So again, the 40% is pretty standard. It just raises the question of, are you really looking at it as a goal to be achieved, or is it an outcome based on true risk assessment of your portfolio? Next slide, please.
All right. And I'll take it from here. Thank you, Kirby. All right, this next slide really looks at the factors to evaluate risk rating accuracy. And this has been consistent year over year with kind of the two most common approaches are the number of grade variances as a percentage of number of loan reviews, and then kind of taking that same perspective, but dollarizing it and doing the number dollar outstanding of grade variances as a percentage of the dollar outstandings reviewed. And then other factors are fairly common. So we see that a lot of these factors are leveraged, but the top two being the number of grades and the dollar of grades as a percentage. And then double downgrades, also a factor, and the number of loans with variances between loan review and the business unit. So that's just a pure number count. So again, all of these fairly significant with the top two, as I mentioned. Then when we're looking at the acceptable level of variance and risk rating assigned by the lending unit versus loan review, we're looking at about 3 to 4% across the board. There's, a little bit of movement across the various asset ranges, but if you're looking at a kind of a benchmark threshold for the industry, it's somewhere between 3 and 4%. And then this slide is rather important. It's easy to kind of gloss over this, but anecdotally, when we're speaking to our clients, we're doing demos in the industry, we're finding that more and more importance has been placed at relationship level reviews, where historically it was kind of a borrower perspective, a note perspective. And we're finding that relationship level reviews are bubbling up. And we've spent a lot of time, energy, and care making sure that the CQS platform supports reviews at all three levels. And we're finding that that is aligned with the responses here from the survey, that really all three levels are pertinent, and it really depends on the type of review, the complexity of the review as to the level of the review. So again, echoed across that all three levels are fairly important across the majority of asset ranges. Then we also kind of follow up and where are exceptions cited, and they're generally cited where they make sense. The borrower level and the note level being the most common, but we're also seeing a trend to start citing at the relationship level as well. And then I'll turn it over to you, Kirby, for this slide.
Yeah, and this is one that if anybody knows me, they know I'm not a big fan of exceptions. And overwhelmingly, you cite exceptions hand over fist, but you don't necessarily count them. And so I have to ask the question, why? And if you're going through the trouble of citing an exception and it doesn't matter, then why are you citing it? And so as someone who has consumed loan review reports for a number of years, the last thing I want to see is a lot of noise in the report. I want to know what the problems are so I can deal with them. And I just have to ask the question is, if you're citing stuff that doesn't matter, why are you wasting time citing? I'll get off my soapbox. Next slide.
No, I get it. And this is a slide that is near and dear to my heart. This is really looking at the respondents and taking your perspective and what you've implemented to automate or not automate your loan review process. So we really have a number of different responses. One is whether or not you're leveraging DiCOM CQS, if you're leveraging another vendor for automation, if you're using a fully automated custom system, a homegrown system, or if you're using a homegrown system and you look at it as just partial automation, you're only looking at optimizing certain key aspects of the review process. And then we have folks that are still using Excel and Word manual processes, but they do plan to automate within the next 12 months. And then my least favorite category here is the manual process with no plans to automate. But we have seen a major shift. We're seeing a shift towards automation across all asset ranges, which I love to see. I know that you're overworked. I know that you're overburdened, and being able to rise above the minutia and really focus on your review work and the meaningful value add stuff is important. So I'm passionate about that. We are finding that most respondents are using DiCOM CQS. So we have grown over the last several years, and we've seen that reflected in the survey. we've also seen that most banks below the $20 billion asset range have either automated or plan to automate their process in the next 12 months. So that is a shift. It used to be that it was less common for banks under 20 billion, and we're seeing that shift, and I love it. We're also seeing that all banks over 20 billion either have automation or plan to automate their process in the next 12 months. So I love this slide. I love what it's telling us, and it's important, and it seems like that has begun to be a shift in the industry. Section highlights. Kirby, I'll turn it over to you.
Okay, section highlights. The primary objectives of loan review are very consistent with the 2020 credit review systems guidance issued by the agencies. However, there does seem to be some inconsistency in the execution, and you just need to ask the question why. Next point is loan review should take care that exceptions don't become noise that drown out the message. The message is way too important, especially today and in today's environment. You don't want to be drowning it out. The next is relationships tend to be more important for smaller banks. The customer still seems to be the preferred approach, but the relationship is becoming more important. And then the last is the use of workflow automation is becoming much more prevalent as portfolios grow, become more complicated. We don't necessarily have the staff, and we can't manage them anymore.
Great, thank you, Kirby. All right, let's look at the credit risk management process and reporting lines. Okay, other responsibilities of loan review. We have seen consistent results year over year with an increase in acquisition due diligence. It's been the top response for as many years as I can remember, but it is going up. And one thing that I think is critical to point out is that DiCOM clients can use CQS to optimize their due diligence review process. And often when banks are not automated, they're looking at the potential for automation just in kind of within the guidelines of standard reviews, scoping, borrower level reporting, et cetera. But often there's additional gains through automation that are not often understood or realized. And this is echoed here with acquisition due diligence. 75% of respondents identifying that as a primary additional responsibility. It's critical that that process is optimized, efficient, and effective, and done so in a way that makes sure that doesn't take away from your core work. Then one-dimensional versus two-dimensional risk ratings. Not a shocker. This is consistent year over year, but we find that smaller banks tend to be one-dimensional, and as you go across the asset range, you find that two-dimensional risk ratings are becoming more the norm, especially over 50 billion. That becomes kind of the standard. So that is what it is. Then who has the final say in loan grading? We like this slide. We like the results. We wish they were even higher, but the loan review manager, 67%, so 2 out of 3 respondents indicate that they have the final say. That is up from 53% in 2020. So over the last 2 years, it's gone up 14%. So we like that trend. We hope it continues. Then some other notables are the chief credit officer as well as the chief risk officer. Everything else is pretty insignificant. All right, loan review's direct reporting line. Kirby, I'll turn it over to you.
Yeah, and so largely coming out of the recession at the end of the 2000s, there was this push for loan review independence, and so the question really became, where does loan review report? And so we've been tracking this for some time, and if you see the direct reporting line, and I'm going to do these 2 slides together, and then there are 2 slides I want to show you together, direct and indirect, and I'm going to talk about them combined. So from a direct basis, about a third of the people are reporting directly to the chief risk officer, and probably another third to 40% are reporting to somewhere around the board. And then the last major group would be the last major reporting line would be the director of internal audit. And if you look at the indirect reporting line, it's roughly the same. It's about a third to the chief risk officer, 40% to the board, and 15% or so to the director of internal audit. And so you saw, but if you look at last year's results, there's a little bit of a shift, whereas the board had a more, there was more of a prevalence of reporting to the board as opposed to the chief risk officer from a direct standpoint. And I'm not sure there's so much of a shift as maybe an interpretation as to who you actually report to. So I think you need to look at them kind of in tandem, that it's, it's somewhere around the board of chief risk officer. What is interesting is that last year, 5% of the respondents said the chief credit officer was their direct report, and 7% said it was their indirect report. This year, it's 0. It's basically non-existent. So from the standpoint of getting credit out of the credit review function, loan review function, you've been wildly successful. So the question is that a good thing or not? So let's look at the next slide, please. And this is one that I think is very interesting and very telling. And if you look at all the different backgrounds of the whoever your direct report is, or your primary report, could be the administrative reporting, only 20% are credit related. Most of the background of the people to whom credit loan review reports are operational risk people. And I think that raises a question for me, is if we've gone too far on the whole independence thing. And you have to ask the question, where is if there is a role for credit in the credit review or loan review function, and what that role is. And I think that's something that needs to be explored. Next slide, please.
All right, and we are at the 4-minute mark.
Okay, so annual reviews, yeah, everybody requires them. The real question here is what do they look like? Are you doing one size fits all, or are you doing risk-based? And that's sort of the $64 question. We'll do some more exploration of that next year. Next slide, please. Benchmarks for criticized classified assets. The regulators have pretty much set 20% as a threshold for Camel 1 rating on asset quality, 16%. So yeah, everybody gets that. Mathematically, that would translate into about a 4% on problem loans as a percentage of your assets or total loans. So those are very consistent with regulatory expectations. So next slide. So section highlights, acquisitions continue to be the primary non-loan review activity. Everybody's acquiring somebody these days, it seems. The ability for loan review to have the final say on risk ratings continues to increase at a somewhat slower rate, but it's increasing. The pandemic may have been a turning point, which is good. There does seem to be something of a shift in reporting lines from previous years. As I said, I'm not sure if it's an interpretation or if it's an actual shift. But what is clear is credit experience is much less important as a qualification for overall management of the loan review function. And then annual reviews are required. It's just a question of are these uniform or are they risk-based? So,
final thoughts. My goodness.
Yeah, key takeaways on this, and I will tell you, we're going to be, and I'm stealing a little bit of Jim's thunder. We'll be issuing a white paper shortly, and it'll be kind of focused around these final thoughts. But they're really kind of some 5 takeaways that I come out of this thing. Number one is the lack of younger staff and a desired work environment. In other words, the old guys want to stay home, have made it desirable for people to move if they want to stay home. And so what's happened is salaries have increased fairly significantly for senior people to compensate for that. You have increasing demands on loan review, and the limited staff and other resources have resulted in an increasing use of workflow automation. There does seem to be some disconnect between the objectives of the loan review and the actual execution of the job. Most banks tend to be measuring productivity in some manner. They tend to be fairly primitive, like files reviewed per week or departmental level metrics. I think that's probably because they're manually derived as opposed to having some sort of automated way to do it. So it takes too much work and you're exhausted by the time you're done, so you don't really get good metrics. And then the last is that credit is becoming less of a requirement for the oversight of the loan review function.
Awesome. Thank you, Kirby. And let's land this plane. So thank you so much for joining us. Did want to point out that we will be distributing the full slide deck to all participants. So you'll be receiving that today or tomorrow via email. The white papers will be distributed by the end of August. So we'll be sending those out by the end of the month, potentially sooner, but don't panic if they haven't arrived in your inbox until the end of the month. Also, Also, please connect with me and Kirby on LinkedIn. We're constantly putting stuff out there related to the survey, what we're finding is happening in the loan review industry, and other important stuff. So follow me and Kirby and DiCOM as well on LinkedIn. You'll have a link to follow DiCOM when you receive this PDF of this deck. And I will point out that DiCOM clients can look forward to breakout sessions and other presentations on the key topics and findings at our 2023 user conference. If you're not a DiCOM client and you want to continue this discussion, you want to be part of our ecosystem, reach out to Kirby or I, and we can talk about, if that makes sense and work that out. But reach out to us. And if there's anything else about the survey, about the findings, or you just want to chat about loan review, reach out to me and Kirby. We'd love to talk to you. We're passionate about this stuff. We love talking about it, and we love learning from the industry as well. So by all means, thank you so much. And I believe that takes us to the very end, and appreciate your time, and look forward to continuing this conversation.
See you.